So what is an edge? An edge basically provides a statistical advantage. It's a process that gives you a winning expectation over time and not every single trade. It's important, as always, to think about a series of 100, 200, 300, the thousands of trades that you'll make over your career, and recognize that even if an edge is present in one or two, that doesn't mean that they're going to be successful. I've seen many A+ setups that end up stopping me out the next day. It's just kind of part of trading, part of the randomness of the markets that we have to deal with. An edge is nothing more than an indication of a higher probability of one thing happening over another. Why do casinos make consistent money on an event that has a random outcome? Because they know that over a series of events, the odds are in their favor. They also know that to realize the benefits of favorable odds, they have to participate in every event. And this is how you should be thinking about your trading.
So the high volume edge essentially looks for one is a stock has to gap up versus its prior day. And second, it's all about the volume. The volume on the day that it gaps up. If the volume is the highest volume ever that the stock has ever seen, for me, that's the most important thing that a stock can do in terms of price action and volume.
Relative strength reveals leaders. Stocks that hold up or rise faster than peers during corrections or, after a bottom is put in often become future leaders once the market turns. And you can watch them for future setups, entry tactics, all of that. This is Reddit. It IPO'd back here, formed a consolidation, moved higher, broke below the moving averages. And then this period, this range is super important here and is really critical. And the reason being is during this period, the market was pulling back hard. The relative strength line was increasing because Reddit wasn't pulling back as much as the market. And what happened after the market pressure lessened and we bottomed here? This went on a monster move. So the end factor is a game-changing catalyst. It's a fundamental development like earnings, revenue surprises, or raised guidance that sparks a significant move in a stock. And basically, institutional accumulation drives a trend, and surprises force large funds to reallocate capital because their spreadsheets are then valuing a stock differently when it earned 100% earnings growth versus what was expected at 25% growth or even 40% growth. So first things first, the Launchpad Setup. This is one of the core setups of TraderLion. It signals the start of a potential major trend. It also helps identify leading groups because as groups are setting up together, you'll see the groups start to curl up, the moving averages start to curl up under all the stocks in the same group. And it's formed by moving average convergence. The setup appears when multiple key moving averages converge beneath the stock price during a consolidation. All right, we'll go ahead and get started. So welcome everybody to the next Trader's Handbook webinar. We're currently on webinar 3, setups and edges. This is going to be a great one of the most important ones that we're going to go through. Just to lay things out and give some perspective, again, we're on webinar 3 of 13. Each of these webinars coincides with one chapter of the Trader's Handbook and dives deep into the concepts. And if you like these webinars, you'll absolutely love the Trader's Handbook. So, Ryan, I think you've got a poll for folks to launch here. We want to see if you guys have pre-ordered
can't
yet.
figure out the poll, so we'll skip that this time, but we'll
just ask in the chat, have you guys pre-ordered the Trader's Handbook just yet? We'd love to see. Yes, pre-ordered. Tom, nice. All right, lots of yeses. Perfect. Pre-ordered, very nice. Awesome, guys. Yeah, thank you guys all to have pre-ordered. If you haven't yet, you can scan this QR code, and this is how you register for the interest list, which sends you a lot of bonus information, and also the link to actually order it from Amazon is on this page. So you can just scan this QR code, and we'll show that QR code here as well. But let's go ahead and keep on moving here. This again is the QR code where you can join the Trader's Handbook waitlist. We'll be sending a lot of bonus articles, sneak previews, exclusive giveaways, exclusive webinars as well. So if you're not already on this interest list, this is the place to be. All the material is free. You just have to join this list, and we'd love to send you all that bonus material. Here's a little bit about what we've sent previously. We've done a preview of the model book chapter. We've written an article on the 3 opportunity zones, common trading problems, reading price action guide, and then this weekend I'll be sending an edges and setups reference guide to go along with this webinar. And don't worry if you're signing up now to the waitlist, and I'll show the QR code in just a minute. Once again, you'll receive all of the previous material. So don't feel like you're missing out on anything. You just have to sign up today, and you'll get access to all of this. And we've got a lot coming down the pipeline as well. I know a lot of people are looking for trade analytics logs. We'll share a framework for that. And there's a lot of valuable stuff that we'll be sending out. So definitely go ahead and join via the QR code, which you can scan right over here. So I'll pause here for just a second to give you guys the chance to do that if you haven't already. All right. So diving into today's webinar, again, this is going to be one of the most impactful ones that we do. We're on Chapter 4, Edges and Setups, discussing everything with regards to the frameworks that we personally use, and taking it a step further and talking about the principles and where edges and setups fit in your overall trading plan and system. So here's a little bit about the agenda today. First, we're going to discuss the SNIP Framework, which kind of introduces where edges and setups and also entry tactics fit into your trading system. Then we'll dive into the key ones that we use, the key edges, the high volume edges, the relative strength edge, the end factor edge. This is one of my personal favorites. We've got a few bonus edges in here as well. Then we kind of dive into our setups, the Launchpad setup, the Gapper setup, the base breakout setup, and then we have one bonus setup also at the end. So definitely stick around until the end. We've got a lot to cover today, and hopefully it'll be immensely valuable to you guys. All right, so first a little bit of perspective. Where do edges, setups, and tactics fit into a trading system? In short, they basically allow us to focus on the right stocks at the right time where we're expecting a large directional move and trend that we can profit from as traders. But I think it's really important to remember that, edges, setups, and tactics are just part of the overall trading system, and we'll talk about kind of where it fits in it. And the reason I say this is because, this kind of covers the buying part of the equation, finding ideas and actually entering a stock. But we all know that winners don't actually manage themselves. Losers have to be taken care of. And there's so many other important concepts and parts of a trading system that we're going to cover in the future webinars: risk management, stop loss management, sell rules, selling into strength, selling into weakness, analyzing your performance. All that is just as important as edges, setups, and tactics. But with that said, I think this is a critical component simply because buying right and focusing on the right stocks at the right time can set yourself up for a lot easier kind of trade going forward, because buying right is often the best defense. Buying where accumulation is present is evident, and we can manage risk very tightly using the entry tactics. And that's going to be the focus of the next webinar: entry tactics and trade execution. But again, just want to emphasize that although this is a very important part of a trading system, it's just one single part of your overall process. In general, edges, setups, and tactics are a template that helps create consistent actions. We've talked a lot about the importance of consistency in the previous webinars. That allows us to improve over time, check in, create feedback loops, and improve our trade execution and improve our trading, identification. All those different components, we need consistent actions in order to judge the outputs. And I think this is really important. Routines will be tailored to find your chosen edges, setups, and entry tactics. Everybody's going to be a little bit different. And today we're going to present kind of our edges and setups and what we use, but you might be a little bit different. You might be more of a swing trader, mean reversion trader. Your edges and your setups might look entirely different to ours. If we think about success in the markets and who's proven that over time, Warren Buffett, his edge is being able to read through financial statements and find all these great bargains or discounts. That's not how we operate at all, but it works for him. And obviously it's worked fantastic for him over the long term. Our edges and setups are much more technical focused because that's how we trade and operate in the markets. But again, for you, you're going to have to kind of decide for yourself, what edges are you going to focus on? What setups are you going to focus on? What entry tactics are you going to use to enter those setups? And again, yours are going to look entirely different. And, you only have to pick a few edges and, one or two setups to have tremendous success over your entire trading career. I think that's a point that we're going to emphasize over and over. You don't have to feel like you have to master everything in the markets. Just specialize, focus on, a few edges, one or two setups, and you can do tremendously well throughout every market cycle. And that kind of gets us into the SNIP framework. This kind of ties back into where edges and setups fit into a trading system. So, first and foremost, here is what the framework is. It's basically an acronym that we developed. And by the way, SNIP was chosen on purpose because it's kind of fits into that theme of specialization, focus, focusing on, just a few setups, a few edges, and that's really important. But here's what it stands for. And edges and setups kind of lines up with the first three components here. The first component is search and scan, which is how we look for current opportunities. Of course, we're going to have an entire webinar dedicated to routines, screens we use, all of that, but we will share a bunch of screens actually today that we use to identify the edges and setups that we use. Then the next step is narrow, and this is focus your attention only on the stocks that fit your system and have strong potential. I think narrowing your focus, as we probably talked about, is one of the most difficult things. A lot of traders have come to us and say, I go through my screens, I've got hundreds of stocks that, fit my criteria. How do I fit down to 100, then 50, then 10, then one or two that I really want to focus on? And we're going to discuss that in today's webinar, as well as in future ones as well. The next step is identify, which is even more filtering out of your potential stocks and finalizing your watch list and analyze each opportunity, looking for the edges and setups we're going to talk about today. And this is kind of where we're going to end today's webinar and with regards to the SNIP framework. And then the next webinar is much more about the entry tactics, the planning the trade, using an entry tactic to manage risk and actually execute your entry. And this is critical. This is kind of complements the first three components. And each of these points is really important to think about as you're defining your trading system. All right, so what is an edge? An edge basically provides a statistical advantage. It's a process that gives you a winning expectation over time and not every single trade. It's important, as always, to think about a series of 100, 200, 300, the thousands of trades that you'll make over your career, and recognize that even if an edge is present in one or two, that doesn't mean that they're going to be successful. I've seen many A+ setups that end up stopping me out the next day. It's just kind of part of trading, part of the randomness of the markets that we have to deal with. This is really important. Risk management is essential. Even strong edges will fail occasionally, so protecting against large losses is critical. And this is part of the entry tactics that we'll be talking about next webinar, where we'll get very specific about where to place your stop, how to set your expectation about what happens next, so you recognize whether a stock is working or it's acting abnormally. Next, and this is also a really important point, edges can become obsolete. Market dynamic shift, which can make once reliable edges less effective or obsolete. And importantly, it's not just a negative. As market dynamic shifts, there's actually new edges that come into play. For instance, before, there were regulatory things with earnings reports, stuff would just kind of come out naturally. Now we've got these gaps that we can actually take advantage of in the markets because of how market dynamics shift and changes in regulations over time. And, you hear about changes that are maybe coming in where 24/7 markets, again, that might change things, but there'll be new ways that we can profit from, those new dynamics. So don't feel like this is a negative. It's actually a positive because we're always learning in the markets. We're always trying to get better and develop new edges. And we've got actually, I think one of the last webinars is talking about how to do studies and find new edges. So that will be a lot of fun. That kind of leads to the next point. Adaptability is crucial. Traders must stay fluid and responsive to what's working in current conditions to maintain their edge. Because not only do some edges become obsolete, but during different periods during a market cycle, during different market cycles, one edge can be, the most amazing thing, and then an edge that's been very reliable in the past might just be out of favor. There's times where gappers are extremely prevalent in the market. There's times where relative strength is the key edge to focus in on. After a market correction, after we bottom and come up strongly, that's when relative strength is really critical. Or during a short-term correction, that's also when relative strength is very critical. So you want to think about, what is the most important edge that has been working well right now or in recent weeks, and that's probably the one to go to and focus on in your trading. All right, so here are a few quotes from Mark Douglas that are excellent. An edge is nothing more than an indication of a higher probability of one thing happening over another. Why do casinos make consistent money on an event that has a random outcome? Because they know that over a series of events, the odds are in their favor. They also know that to realize the benefits of favorable odds, they have to participate in every event. And this is how you should be thinking about your trading. And, just to summarize how this applies to trading specifically, we are looking for price and volume characteristics that appear again and again before and during the moves of historical winners. Again, this is a really important point that you guys all should be taking notes on. We are looking for price and volume characteristics that appear again and again before and during the moves of historical winners. And I also want to kind of generalize this. It doesn't have to just be price and volume characteristics. Your edge, like we talked about with Warren Buffett, could be diving deeper into the fundamentals, identifying the theme that is working really well in the markets. It could be looking at increasing sponsorship, which we have in DeepView in terms of number of funds. It could be looking at net profit margins. Whatever kind of similarities occur in many of the best historical winners in the past, anything that you can distill and kind of create a blueprint for yourself about winning stocks, that can become an edge that you can use in the markets. Rye, I want to throw it over to you with regards to these quotes. Anything else that you want to emphasize here based on what Mark Douglas said?
Yeah, I would say the most important here is if you guys have an edge in the markets, maybe throw a comment in the chat of what your edge is and how you execute it. I think it's a very important question to answer to have. Many traders instead, like we spoke about in the boom bust phase, and anything before the consistency phase don't have a clear edge written on paper or what they know to be an edge in the markets that they can repeatedly execute again and again. So if you're operating without one, it's a good time to pause and take a step back and look at your trading and likely if you can't, explain it to someone else in a very clear, 1 to 2 words, it's likely you've confused yourself as to what an edge is in the first
Exactly.
place. So it's very important to know what it is and how you identify it. And then today we'll cover some of our playbook at TraderLion and what we call edges and setups and how they play a big part in being a swing trader or a position trader.
Yep, I see people listing their edges, and I actually asked that question later, so we're jumping the gun here. But
Okay.
cancel and gap ups, post earnings, trend, convergence of MA is nice. The Launchpad setup is kind of that nice. I see Gary says my edge is DFU. Thank you. You know, we built in a lot of things to make us help us find our edges a lot faster. All right, let's keep going here. We did want to touch on a little bit this concept, and Ryan, I definitely want to hand it over to you because I think you
Yeah.
explained this really
So
well. Go ahead.
position sizing, we'll dive deeper into that and the mechanics of it, but it's important to cover an approach that is not talked about enough, or folks are not looking at the markets this way. So let's say we have an edge in the markets and we know that um, a gap up in the markets or something that happens or characteristics like oops reversal in the market has a favorable probability if we execute it over the next 50 to 100 trades while the market's in an uptrend. A very simple system, right? Now, how do we position size based on our edges? A lot of people tend to not bridge those two concepts together. And what this slide essentially speaks about is the more edges that you see on a single chart, be it a technical edge, a fundamental edge, a news-based edge, catalyst, whatever the case might be, you have these particular edges that you've studied and mastered. If multiple ones are showing on the same chart, there's no reason for you to size up. There's no reason for you to not size up that particular chart A, which has multiple edges, versus a chart that may have a single edge that you've mastered in the markets. So building your position sizing system based on the number of edges that show on the charts will allow you to get into the winners with heavy size and get into the ones that don't exhibit many winning characteristics or edges at the same time with lesser size. And what happens is the math plays out and naturally over it, as you execute your system, you're the biggest performers in the market will get the highest amount of size. So, position sizing boosts your performance. We all know that. If you put on a 25% position in a market leader for that year, like APPS or some of these other ones, Uber, etc., and they move up 100 plus percent, if you versus if you only have a 5% position, it's pretty clear which one's going to move the needle. More edges equals more conviction. So if I see a high volume edge, it's showing relative strength, it's in the right group, right? And the market's behind me, there's no reason for me to sit there with a 3% position size and feel happy about myself, right? We want more position size in stocks that are showing more potential. That doesn't mean that they might not fail. If they do, we take that loss and move on to the next one. But most likely, the ones that show multiple edges will outperform the markets a lot more, and you want to have higher size. So using a system based on just that alone, plus, adapting to each market cycle as well, will allow you to really get into, a Tesla last year where it moved and broke out and moved, 50 to 60% in 3 to 6 weeks, had a lot of things going on at once. So people size that up. You see a huge move, and then when the market goes bad, you get stopped out. It allows you to sit there and do nothing, right? You sit in cash, you're more patient because you know that when your edges start to show on the charts, you will again start to act in the markets. So this concept, very powerful, but the first step again is you have to know, you have to have multiple edges in the market so that when they correlate, your confidence goes up and your conviction is really there at the end of the day.
Yeah, just to add, two of my best trades last year, A-Lab and Reddit, I sized higher because I saw multiple edges, and they really contributed to a strong end to last year for me. And, if I kept my normal size, it just wouldn't have had the same impact. And when I have more conviction, I adjust my position size, just like we show in this example, incrementally more based on the number of edges that I see. And that allows you to just take advantage of the best, highest conviction trades. I've talked to Christian Flanders, one of the top performers of the U.S. Investing Championship last year. He uses this process in the strongest setups like Nvidia and SMCI of last year. He sized higher, and they really made a difference in his performance. And obviously, you have to tailor this to your experience level, your ability to manage risk. We never want to take outside risk. So within your parameters, say you've got a max position size of 20%, like we show here, you don't want to, size higher than that if it, puts you outside of your parameters. Even if you have a lot of edges, present. Just in general, we want to be sizing higher when there's a higher probability of a really strong risk reward setup. That's kind of the main point we want to hear. And maybe if you're starting out, you might only add 1 to 2%, 2.5% for every additional edge. You just want to tailor it to your system and how you approach things. But I think this is something that will dive a lot deeper into the risk management portion, where we'll also talk about position sizing, and we'll give a really clear framework for traders of all experience levels. What should be your base position size? When should you size up? How does that change based on market conditions? How to use progressive exposure? We're going to dive all into that. This is just kind of introducing this base concept. All right. So getting into the meat of it here, what is a setup? While edges signal opportunity, setups define structure around that. A setup builds on edges to form a larger, recognizable trading opportunity and pattern. A setup is repeatable. It's a pattern that consistently presents a favorable reward to risk ratio. And these formations, these patterns are created because of supply and demand accumulation by institutions. They're not just things that we memorize. They're created because of market dynamics and the factors at play, strong accumulation and risk appetite by institutions, all of that. They're just not, we don't just want to memorize what a cup and handle looks like and just say, all right, these always work. Everything's in context. Everything is based on how the market is currently presenting and developing, and all that is going to form the setups that we see. Edges are a component of a setup. A good setup incorporates multiple edges that align in a cohesive structure, and edges are also how you identify strong, high potential stocks to identify those setups as the next step. Setups also include entry tactics, which will be the focus of the next webinar. They don't just show opportunity, but also outline how and when to enter a trade while managing risk. We at TraderLion and how we trade, we focus so much on tight and logical entries where even if we think a stock is the best opportunity out there, we're not going to ignore risk. We're going to manage it tightly and look to enter at points where we can know very quickly if we're right or wrong. Exit with a small loss if we are wrong, but get on the train, get on the plane, whatever you want to call it, when the stock is really taking off and developing and maturing as a setup and looking to make a strong directional move and trend. The strength of a setup lies in confidence. This is kind of what we were getting at with the previous slide, with increasing position size based on number of edges. The more aligned edges and patterns within it, the more powerful the trading opportunity. Just looking at the best stocks in recent history, Tesla in 2020 showed relative strength. it showed tight price action, it showed power off the lows. All those came into play and showed you that it was really under accumulation by institutions. And after that, it went up another 500% after showing all those different edges and winning characteristics. So that's really, really important. Always look for confluence and multiple reasons why a stock or trade has high potential. So what is an entry tactic? This is kind of the final layer, and we've touched on this a little bit. It's the last piece of the puzzle after identifying the stock with edges and setups. They allow us to control risk tightly and logically. They help traders enter positions with precise stop levels and risk control. They enable proper position sizing based on that amount of risk that you're taking. And well-timed entries allow for putting on enough size while still managing risk. This is kind of what I was getting at when I said buying right is often our best defense, because if we buy properly from a mature setup with a proper entry tactic, we are basically, it makes the trade a lot easier because you're not taking outsized risk. You know quickly if it fails or if it's going to work, and you get that quick feedback in the markets. They're also execution focused. Entry tactics are where the trade execution actually happens, and this is going to be the topic of the next webinar. We're going to get really in depth into the entry tactics that we personally use and how we actually execute our trades. Where do we set early alerts? How do we prep orders? All of that is going to be covered in the next webinar. This is kind of creating the overall framework. Edges and setups, again, allows to identify promising opportunities. So this is a very simple, but I think effective graphic to kind of summarize how edges, setups, and entry tactics fit together. Here, of course, we've got an uptrending stock. You could say that this is showing very strong relative strength. It's a really strong prior uptrend. Maybe it doubled during this period. This is kind of the edge that gets it on your radar. Stocks that double like to double again. Then the stock begins consolidating, forms out a base, goes through a nice mature basing process. This is kind of the longer term setup, the larger pattern that says, it might be set up for another leg higher to resume the strong trend that it showed with these edges. Then, the last piece of the puzzle is how do you actually enter and execute within this larger pattern, the setup, and that is the entry tactic. Here we've got a consolidation pivot breakout, breaking through the short-term line of resistance, managing risk maybe at this higher low or at the low of the day as it breaks through. And this component is the last layer, as we talked about, the entry tactic. So again, the edge gets it on our radar. The setup is the larger pattern that suggests strong accumulation, and entry tactic is how we execute our trade, enter the position, set our risk parameters, set our position size. It's the last piece of the puzzle. So I think this is a good kind of summarizing and simple graphic. Right. Anything you want to add about how edges, setups, and entry tactics kind of fit together to create a strong trade?
An edge has to be visual in nature, right? A setup forms over a span of time, right? An edge can show on one day, on a particular day on the charts, right? Could be high volume, relative strength. It's
Right.
there, it's visible, you can see it. There's no subjectivity to it. There's no opinion to it. It's there on the charts. When it comes to catalyst or news base, there might be some of that, but when you refine all of your edges, they have to be crystal clear that, hey, I see relative strength, I see high volume, I see a stock in a leadership group, and the market is in a uptrend, right? We can define those very mathematically or numerically or visually on the charts, and they show up. Second is a setup. A setup essentially forms over a span of time. So these patterns that we speak about, either be it candlestick patterns that eventually form a setup, or the William O'Neill bases, which eventually form a setup. These are things that take time, and the structure on the charts is built through price action and volume, which we spoke about in our previous webinars. The entry tactic essentially is saying, where within the setup can I define my risk? As soon as I can define my risk, I have an entry tactic, because if I have a 2%, let's say stop loss, or 2.5% risk on this particular position, I know where I'm going to enter. I know where I'm going to get stopped out, and my thesis is invalidated. That's essentially what an entry tactic is. So these three mechanisms should play out in each trade, right? I have a watch list that only tracks my edges, for example. I can have a relative strength watch list, right? Then as I'm tracking, when I have my relative strength list, I'm tracking for setups to form on that list. When many setups form within the same group, for example, that's an additional edge, right? You want a theme to back up, a particular stock. Could be AI based or semiconductors or software or things of that nature. And then the last part, how do I enter this thing? I know that these things exist, but if I can't define my risk, it's a washout. It doesn't matter. So at the end of the day, risk management always comes first. Traders always say, I know exactly where I need to enter and I know exactly where I need to exit. Because if I don't, then other things come into play and you become an investor and not a trader, right? So that's how I think of edges, setups, and entry tactics and why we built this whole framework to get traders to think systematically and to think visually and not, take again the randomness out of what they're doing through this particular framework, edges, setups, and entry tactics.
Yeah, and I liked what you said there. Edges can happen on one day. There could have been a huge gap on volume within this uptrend that gets it on your radar. There could have been a huge high volume day that gets on your radar, relative strength as the overall market was correcting. So there's many different ways that a stock gets on your radar, but those are kind of what your edges are. Then within the setup, we highlighted this particular entry tactic, but I want to be clear, you don't have to use a consolidation pivot breakout. There's traders who prefer to trade the mean reversion extension down recovery phase right here to find their risk at that low and finding specific spots. There's people who maybe trade this first higher low. All of these are valid entry tactics if you study it, if you can manage risk, and if it's repeatable over time. You just have to develop kind of for yourself what are the edges you want to focus on, what are the larger setups and patterns that you want that show high probability for how you like to trade, and then what are your entry tactics and set of entry tactics that you can use to execute within that setup. And we'll kind of complete the link next webinar by talking about the different entry tactics we use for the different setups that we present today. But this is just kind of an overall example, a very high level example of how these three fit together. All right, so getting into the edges here. This is kind of the TraderLion playbook. These are the main ones that we use. We've got number one, the high volume edges, which Rye will dive deep into. Number two, the relative strength edge. Number three, the N factor edge, which is also the N in Can Slim, the new factor. And then number four, we've got a bonus, the market/thematic edges, because we know that the market has a huge impact on the success of a trade. We also know that the theme that the stock is in, and if it's a strong theme or a weakening theme, has a huge impact on whether a particular setup will be successful. So these are the main four we're going to cover today with examples and screens for each of these. And, I personally, this is probably the number one that I focus on, the relative strength edge. Also incorporate a lot of the N factor edge in number four, while Rye, favors the high volume edges. This is his bread and butter. So he focuses more on those. So for whoever you are as a trader, you have to come up with a list like this of the main ones that you use, that you are confident in, that you've studied, gone back and studied previous market winners, and identify the strongest potential stocks for your style. So you should kind of develop a list for yourself. And let's dive into number one, the high volume edges. Rye, I'll hand it over to you, and definitely explain what these acronyms stand for.
Yes. So one of the things that I look for in the markets is a very simple representation of demand or something that happens in the market that spurs momentum to the upside and results in stocks eventually having the market forces behind it to double and then some thereafter. So the high volume edge essentially looks for a couple of things. One is a stock has to gap up versus its prior day. And second, it's all about the volume. The volume on the day that it gaps up, if it's up 22%, 22 to 25% on a particular gap up, if the volume is the highest volume ever that the stock has ever seen, for me, that's the most important thing that a stock can do in terms of price action and volume, right? I want the bar on that day, I want the price to be as close and closing near the high of the day as possible. And I want the volume on that particular day to be the highest volume that the stock has ever traded. That to me is the most important volume signature that exists in the markets. And what it tells me is there's a sudden shift in dynamic or something has happened It's always news, earnings, catalyst, something that the company did to catch everybody off guard or are, something amazing that causes that price action and volume to happen. The second one is the HB IPO, which essentially stands for the highest volume since IPO week. Now, the highest volume since IPO week, again, is based on studies, which we'll cover near the end of this webinar series on how you do studies. And all of these are essentially observations that were made and then turned into an edge for me in the markets, right? So the highest volume since IPO is when a stock gaps up, and it's the highest volume it's seen since the first time it IPO'd in the markets and was listed publicly. That particular volume signature is something that I noticed in Facebook's and Spotify and things of that, Twitter when it actually traded publicly, and many companies exhibited some of this particular volume signature. So I added this as kind of the second most successful volume signature that I see on the charts. The third one is the highest volume in a year. And now this quantification of highest volume in a year is also based on stocks. Hey, I was seeing the highest volume ever, which is the most obvious thing that you can see on the charts. I was seeing the highest volume since IPO, but I was still missing some momentum names that, which we'll cover in the next few slides here, that again doubled, but they weren't on my radar because I was only looking at the highest volume ever or the highest volume since IPO. So that was the third edition, the highest volume in a year. And that kind of completes everything that I look for under the high volume edge. It's very visual in nature. There's no second guessing. I can see on a single price bar if this has happened or not, and then I can get into more, more analytics of why it happened and what's happening and things of that nature. So catalysts on these particular names do matter. If a particular company is, let's say, being driven by like a GME type of name with the highest volume ever, is that something that is of high interest to me? And I think that GameStop has now changed as a company overnight. Likely not, right? So analyzing why it happened it matters a lot more now, especially in the past 4 years, 4.5 years, since 2020, since retail volume has come into the market as well. The HV Edge is a representation of institutions coming in and being interested, right? Essentially, it's huge volume on the charts. It's liquidity. There's something amazing that's happened, and institutions show that by participating, and participation in the market shows in volume, right? And price. So a good, a very simple screen. We've built all of these into deep view. If you use that, it's, you could scan for each of these characteristics, the HVE, the HVIPO, the HV1. They're all present and scannable. We've built those into the platform. And I think we could cover, Richard, a few examples to really dive deep into this as well. So I'll start annotating. Let me know if you guys can see my annotations. But essentially, when we say that we're looking for the highest volume ever, it's on the daily chart. That's first and foremost, that's the time frame for this particular edge. We're looking at the highest volume ever on the daily charts, and this particular chart is ASTS, right? Now, ASTS was in a downtrend, had nothing going for it. Essentially, it was below moving averages. There's nothing of interest. There's, in this particular way, there's no way I could have entered here and caught the gap. That's not of interest to me in the markets. What's of interest to me is what happens on this particular day, right? This particular day, the stock gaps up. It has a strong close, right? It closes right near the high of the day. So the closing range, which we covered in the first two webinars, is very high, which is constructive price action. And then second, it's the highest volume that the stock has ever seen. And that to me, that's the edge component of it, right? Now we've identified a visual thing on the charts. It's the edge that I see. Now we look for a setup and then followed by a entry tactic. So essentially the stock gaps up. There's a couple of entry tactics which we'll cover in the next webinar that we'll do. In this case, the HVC was the most effective one, or the prior higher day was the most effective one as well. So the stock comes in, holds the HVC in the prior day area, But again, it goes up and rallies. It goes from essentially $3 to $22. But how did it all start? It started with the highest volume ever. If you scan for these on a daily basis, what we're trying to teach you is a simple framework for you to become a swing trader, position trader in the markets and to see things visually without, guessing or opinion and things of that nature. So it then gaps up again on another partnership announcement. That's the catalyst. And once again, we see the highest volume ever. Now, this is the second time the stock has seen the highest volume ever in a short span of time. Does this happen on every single stock? No. But if you missed it on this particular gap up, now we have another, strong closing range, which we spoke about. Strong price action followed by the highest volume ever. It's visual, it's on the charts, you can identify it, you can place this name on your watch list to then track for a particular setup. In this case, the best entry, and I remember this, was the volume support, which we'll again cover very in depth in the next webinar. Also the HVC area right here. And the stock then consolidates. And then again, even if you didn't catch it from the initial $3 mark, you're now, the amount of time that you see that stocks that gap up into the $7 area, it's again about entry tactics. This happens quite a bit where they go from 7.5 to $20 and plus again and again. But what's most important for today is for you guys to visually master an edge in the markets and walk away with, this could be something that you potentially look at on a consistent basis in the markets as well, which is the high volume edge. Learn to identify these, learn to look at the markets, look at charts this way and place these names on your watch list. And over a span of time, you'll start to see how successful these are, especially which we'll get into when the market is backing, the market cycle is positive. It becomes a lot easier. There's a lot more momentum. Risk is well defined, and you get a lot out of it. It's the only, it's the primary edge for me in the markets that I look at on a consistent basis. So, Richard, I don't know if you want to add something, or we could go to the next example. You're on mute. Mute.
There we go. Yeah, just to double click on something that I think is really important. These signatures, the highest volume ever, is what gets it on your radar. After it's on your radar, then you can apply your particular setup or your particular entry tact to execute on the name. Rye has his HVC setups. I actually traded this in the high tight flag setups from Inside Days over here much later than, many other opportunities back here. But these edges are what gets a high potential stock on your radar. I'll add that basically this was part of a leading theme potential leadership group as well. RKLB was acting well. There's a lot of positive catalysts about SpaceX, which wasn't traded on the markets, obviously, but this theme was in favor during this time. And that all kind of amplified the power of this trend. And I love how we had the highest volume ever and then even higher highest volume ever. And this is very rare to see this back to back. Tesla back in 2019 had it as well after it reported profitability for the first time. But this signature, the highest volume ever, is really key and can be game changing. It can completely turn around a stock. There was a question in the chat. Does it matter if it's below the 50 SMA, the 200 SMA when this occurs? What ideally, is the situation that you see HVE?
For me, it's a whole reset that happens, be it below the 200, below the 50, etc. Not often, not many times you'll see a HVE below the 200, but if it happens, it doesn't matter where it happens on the chart, as long as it's a gap up of sizable amount. There's a really good catalyst like a partnership announcement or a theme or something that's happening to back it up. Could be earnings, right? That's the biggest one. And it doesn't matter. It's a reset. When I look at this, I'm not sitting there saying there's overhead resistance, I should be careful. No. There is new volume, there's new interest, there's new people, there's something that's happened on this particular day that negates all of this price action to the left because it's a huge reset. It's something's happened that's completely separated the stock from its prior action, right? It's something new. So I don't look to the left and say, oh, it's run into resistance. Oh, this is where I expect it to stall. There's a lot of negatives that you will find in these highest volume ever when you look to the left. But there's no reason to do that because the volume is plowing through anyone and anybody that's kind of short the stock at the moment. And the story, the catalyst, the earnings, the sales, the news, the announcements, whatever the case might be, it's a great reset. And all of this doesn't matter to the left.
Yep. And Eaton in the chat pointed out, some great things. This is an excellent chart to study, and it's in the model book chapter of our book in terms of price and volume action, pullbacks on low volume, tight areas, inside days right before the breakout. Everything we talked about in the previous webinar, you can see really apparently respecting the 21 EMA. This is a great case study to look at in terms of studying price and volume action, how it all comes together, expansions after tight areas right here, another tight area, expansion up, tight inside day, expansion up. What's that happening on? Higher volume. So there's a great stock and chart to study in terms of price and volume action. The other thing I want to talk about is this isn't the hindsight trade. I actually was recording a video for DeepView looking for gap ups like this on the day that this occurred, and you can watch it on YouTube. And ASTS is the example that I shared in terms of a promising gap up that then gets it on your radar. And we've got a few screens later on that show how to catch these gap ups and how to fit it into your routine, because it's not just about having a screen that looks for gap ups if it doesn't fit into your routine and you don't actually look at it to find these potential setups. So we've got a few screens to share later on. Here's another example with Arlo Rye.
Yes. So I see a lot of questions in the chat. Does price matter? Does it matter where it happens? Is $4 or $5 way too low? So I added this example just for that, just to anticipate some of the questions that would come through. So Arlo is the same situation. The stock back in, I believe, 2023 or 2022, gapped up on amazing volume, right? So something that happened, was not known here, not known here, and the stock just purely gaps up. And on that gap up day, we see huge price action with a really amazing closing range, right? So constructive price action and the highest volume edge shows on the charts. And when that shows, it's our job to then take a look at the charts, place it on our watch list, and start to look at the setup that is about to form. One of the things that we'll cover in the next webinar, but also I'll cover here, is that the fact that when you have the highest volume edge show up on the charts and it's right around a whole number, and that whole number is $5 or $7.50, you'll tend to notice that it creates additional momentum in the stock. So again, you identify a visual edge, you scan, the SNIP framework, you search and scan for this particular edge in the markets, you place it on your watch list, and in this case, the entry tactic was a whole number plus the HVC area, and the stock goes from $5 to $10 in a matter of less than 3 months, right? So this is another example for you to take a look at. It's very visual. You can place it on watch list. There's follow-on, follow-through volume. There's consolidation. The stock is supported right at the HVC and the $5 area. It then rallies and then it catches another gap based on earnings. So you get additional momentum, and then you get into the $10 range. So this stock actually continued quite a bit higher, but this right here is again based on the HV edge. So there's another example we could flip to, Richard, that I added.
Yeah, before you do that, there's a question
Yes.
from Fred about, do edges all have to happen on one day? No, but a single edge can happen on one day. Like the HV edge here, this happened in one day, and then this edge is valid throughout this uptrend as being an HVE. So you want to look at recent price action, the past month, the past few months within that same trend. What are the edges and character and winning characteristics that you're seeing recently in the stock? So hopefully that clears that up, Fred. All right, here's the next example, PLTR.
PLTR is a really good example of a very well-known company, right? That was in a downtrend and couldn't catch a bid, and something happens on earnings where it gaps up on that particular day, and now you have this was a company by the highest volume in 1 year, right? So on this day the company gapped up. They announced a couple of things as well. We see that there's a prior downtrend uh, prior to earnings, and something happens where the catalyst is big enough to justify not only a price gap but really constructive action on the day it gaps up as well, accompanied by, which is the most important part, the high volume edge that we defined a couple of slides ago, right? You will see this in Roku back in 2019. If you pull up the charts, Roku was down 20 sessions in a row. It couldn't catch a bid. Reported earnings got a huge gap. Everything reset on the charts thereafter, and it also catched anyone that's short on the, when you look to the left. So that creates additional momentum in that particular name. Again, it all starts with the HV edge. You take a look at the volume, and you take a look at the gap, you place it on your watch list. In this case, the entry tactic that worked well was the volume support, the HVC area, and also the $10 mark. So there were three layers of entry tactics, which we'll cover in the next webinar really in depth as to how the setup formed and how we can define risk at each of those areas. And what happened? PLTR. This is what started PLTR to go to where
A
it is
thousand
today,
percent.
by
Yeah.
the way.
Yep.
So that's why it's very important to track these names and track why they're gapping up or what the catalyst is. You'll start to see patterns in the catalyst that you see. If a company is reporting good earnings, the first time they're being profitable on an earnings per share basis, or revenues jumped quite a bit, or they've announced $1 billion that they're now allocating to buying back shares from the market to reduce their float, things of that nature. When they all align, that's what happened over here, which created the cocktail for 100% increase from 10 to 20. And then, this will remain on your radar for many, many, many cycles, all the way up to $150, right? So that was I think the third example that I had.
Yeah. And by the
Um,
way, I saw some questions about what HVC stands for. HVC is the close. That's what the C is in HV of the high volume day. So high volume close is HV. So, and this becomes a very relevant level in the market. You'll often see stocks pull in, respect it, rally up from it. We've got an example later on with ELF. It loved to gap up, set it HVC. It would trend and then pull back to its HV. It did that like 5, 6 times. It's amazing. And I think this is a great example because, Ryan, you talked about volume support here being kind of your first entry tactic here. I trade differently than you. And, I would have looked at this very tight day right here, which basically is like a inside day in spirit. I'd be set a pivot above that high, which also lines up with the HVC. And then that would be my buy on strength on that. So your entry tactic is different than how how I would enter and use my entry tactics. But it's all about finding the edge first that gets a high potential stock on your radar, and then I would trade it how I trade it, you would trade it how you would trade it, and everybody watching would have their own individual setups and edges and entry tactics that you could use to then apply to this stock. So I think
yeah,
that's a really good
so
example.
there's a couple of, questions in the chat. Like, can I use the open range high as the entry tactic on that particular day? Can I do, does the stock have to meet the 52-week high when it gaps up on the HV day? So all of these questions, do I look at them? I don't have to look at them, but if you find it valuable and you see more success in those, then you go ahead and use those. What we're trying to do is give you just a framework of how you can operate in the markets, which is edges, setups, entry tactics. And this is one of the edges that I use in the markets to show you the application of that system, the edges, setups, and entry tactics. So you could use open range breakouts. You could use the ones that we'll teach you in the next webinar. You could use none of those entry tactics and come up with your own, right? It's all fine as long as you could define risk, right? And as long as you can identify using the SNIP framework, you're going through that framework and consistently, repeatedly identifying edges, setups, and entry tactics in a loop or in a repeatable way. It will make you an amazing swing trader.
Yep. Go back, study history, see if it works, right? See if it works for you in the moment too. That's what you gotta do. All right, we've got Uber
We
here.
got one more. Let's do one more example. So this one was Uber. This one I traded. So again, the same thing. There was a lot of, I would say, pessimism, or the stock was in a downtrend coming into earnings. Uber then reports its first profitable quarter in since becoming public. That creates a gap up on this particular stock. The stock outperforms the market, and is now outperforming the markets. The market trend was amazing as well. And there was years of frustration coming into this particular gap up that this company's not going anywhere, just like Airbnb these days. That stock is all over the place, has done nothing since IPO. But something changed on this day, and that was, it was the first profitable quarter for Uber. And what happened was it spurred an amazing run in that particular stock. Again, the point of this is there's a really visual edge on the charts. This was the highest volume in a year that Uber's ever seen. It was in a downtrend coming in and it gapped up. The closing range on that particular day was in the 90%. The DCR was in the 90%. And the catalysts were there for this new tight price action to start showing on a company that would trade really poorly prior to this gap up. So there's a character change, there's a new catalyst. Institutions were more confident that this company can now be profitable. Things of that nature, they all play a role. But all of that shows in volume. That confidence, that conviction from institutional side, retail trader side, what have you, all comes in and shows up on the chart as a visual edge, which is volume, and it was the highest volume in a year. So that was the last example.
Great. So getting into the next one, the relative strength edge, this is probably something that you guys already use maybe, or is pretty common out there, but it's one of the most powerful edges that you can apply. Relative strength reveals leaders. Stocks that hold up or rise faster than peers during corrections or, after a bottom is put in often become future leaders once the market turns. And you can watch them for future setups, entry tactics, all of that. Key relative strength signals include the RS line making new highs, outperforming on 62.5%. This is a study that Rye did looking back on relative strength days. So on 62.5% of down days, if a stock outperforms, it could be a leader after the market turns. Holding above moving averages when the market is below them, and otherwise showing strength during market weakness are all ways that you can identify the relative strength edge. And we've got a lot of examples to show, different ways to define relative strength. And why does this happen? The reason is because institutions, this is the driving force behind market leaders and behind relative strength. During a correction, during weakness, institutions are going to look to add shares in their highest conviction names that they're still aggressively trying to add to, and that demand supports a stock better than the rest of the market. So strong RS stocks attract capital during pullbacks, and as institutions add to high conviction positions. Exactly what I just said. And on the flip side, if you see very weak action during a correction, those are names that are being distributed by institutions as they try to hold on to their strong stuff and get rid of the stuff that they want to sell anyway. The RS line is the key for identifying the relative strength edge. The relative strength line is basically plotting the price of the stock divided by the price of the SPY. And it basically gives a day-by-day measure of whether a stock is outperforming or underperforming. If it's rising, the stock is increasing relative strength. If it's declining, it's decreasing relative strength. So the RS line, as I mentioned here, compares the stock's price relative to the market index, likely the SPY, and shows trend-based outperformance, not just momentum. And I want to be really clear here because a lot of people get confused by this. The relative strength line is different than the RS rating. The value of the relative strength line, because it's just a ratio, it's just the stock's price on any given day divided by the price of the SPY. That is just a ratio. The value itself of that ratio does not matter. It's the trend of the line that matters. The RS rating compares the relative strength over a period to all other stocks in the market, and then creates a measure and percentile score for that stock. We have both in DeepView, and both are very useful, and both are measures of relative strength, but they're not related. The RS rating is not going to be the value of the RS line. They're different metrics. So I just want to make that clear. And here are a few really good scans that we have presets in DeepView to help find relative strength, and each of them kind of look for different things here. So first things first, we've got one I called relative strength phase. A relative strength phase is when a stock is trending above, the relative strength line of a stock is trending above its signal line, the 21 EMA. And basically this screen right here is looking for a stock that is liquid, over $10 in price, rising above its 21 EMA, above its 200-day moving average. It's a common stock or ADR, and it's in that RS phase. So it's trending above its relative strength line. Then here we've got an Oliver Kell preset, one of the key screens that he looks for and uses during down days. And this is when the market, is down 1%, 2%, 3%, very similar to the Action Friday. And these days are actually great for identifying relative strength because they get they kind of show you what's obvious, what stocks are being supported, what groups are being supported on a day where everything is getting taken to the cleaners. And one thing I really want to make clear about relative strength is it's not enough to show relative strength on one day or at the beginning of a correction. What's really important is to see sustained, persistent, consistent relative strength day after day, especially after the market seems to have put in a bottom. The stocks that show relative strength over the course of the correction consistently are the names you want to focus on, not a stock that showed one day of relative strength and gapped up early in a correction and then got taken to the cleaners. That's just relative strength on one day. We're looking for consistent relative strength over the course of the whole correction to show that consistent accumulation by institutions, that support by institutions. So this screen right here, basically looking to see, is a stock up on a day when the market is down, is how you can determine if a stock on that day showed relative strength. And then you want to keep track of what Ryan, we call a relative strength list, and say on March 29th, these stocks showed relative strength, have a list here. Then the next day, you have another relative strength list, especially if it's a down day. And then you look for the common stocks that show up again and again on those relative strength lists for each day. And that's how you find the next potential leaders. So hopefully that was helpful to you guys. And I think that's a key thing we want to get across here. Then on this last scan here is another one that looks for relative strength on a particular day, but instead of just seeing if a stock is up on the day, it's using daily closing range. And we talked about that in the previous webinar. Over 50% suggests accumulation. This actually looks for over 75% on a day that's very negative. So if the SPY has a closing range of 3%, a stock that has a daily closing range of 75% is definitely something that you want to review and potentially add to that relative strength list to basically take note of. Right. Anything you want to add about looking for relative strength over a consistent basis or any of these screens in particular?
So the gist of it is stocks that outperform the markets are showing greater relative strength. Or when a stock outperforms, let's say the Nasdaq is up 1% and the stock is up 3.5%. That could be a mechanism of its beta, right? And how it trades in the market, but it's also outperforming the market. It's stronger than the market itself. That's one form of relative strength. The second is the biggest one, and a lot of questions in the chat, is RS only when the market's in corrections? I'd say no. So if the Nasdaq is down 3%, right, and that same stock is only down, let's say 0.5%, that's relative strength, right? It's down on the day, but it's down much less than the markets, or much less than what we would expect, let's say a stock with a beta of 2, right? The second question that I saw in the chat is, what is beta? Beta is a stock's performance relative to an index. And you could define that index depending on where you are in the world. As in the United States, we define beta versus the S&P 500. That's the benchmark, right? And if you're outperforming the S&P 500, your beta is above 1. If you're not out, you don't tend to trade more than the S&P's performance, your beta is less than 1. So relative strength is all about, it's again, the second visual edge for you in the markets. Stocks that consistently outperform the markets, be it on up days or down days, those are the ones that you want to be in. You want to be in market leaders. Market leaders show relative strength. That's it. That happens every single market cycle, and that's a guarantee, because there's no way you can hide on the charts to, let's say, be down 50% the next day. That doesn't happen. They always show relative strength consistently. And we have a stat somewhere that in a correction, if a stock is outperforming the markets 62 or 60, let's just 60% of the time, the chances of it being a market leader on that next uptrend are very, very, very high. And you'll see that in every single market leader. If you go through our model books that we make every year, that statistic will stand true. And that statistic was created based on our model books and the studies that I've done as well. So it's very important, if you want to be in stocks that have the potential, right? Some show relative strength, but then fail when the market turns. There's no absolutes when it comes to that. But many stocks, or if any stock is up 100%, it's shown relative strength, right? And that it will show on the charts for you. So that's why it's important.
Yeah, and what I want to add here is these are just three examples of screens that you can run in Deep View to help find relative strength. But there are many different ways to find relative strength. Somebody, I think Alberto said Ross Haber's RS New Highs screen is great. That's a great one to use as well. And actually, how I look for relative strength changes depending on kind of what the market is doing. If the market just broke below the 21 EMA and is very negative, I might run a screen that looks for stocks above their 21 EMAs because it's holding above a moving average that the market is doesn't. If the market has looked to put in a sustainable bottom and we're 5 days away from that bottom, where we rally for 5 days, I might run a screen or sort my columns of my other screens by 5 day percent change to see what stocks bounce the fastest off that local bottom. And that's actually a golden nugget I learned from Yves Bobach. If the market has bottomed a month ago, run a screen and see what stocks have performed the best over the past month. And likely, they're still going to outperform because they've been accumulated the fastest off the market bottom as the risk appetite, improved. Just wait for that next setup. They might not be set up actionably that day or the next week, but wait for a moving average pullback, wait for the next base breakout. So I think my point is there's many ways to scan and look for relative strength. Find the way that makes a lot of sense for you, and you can definitely use these screens as kind of base filters. And we've got other presets in Deep View that help identify that relative strength. And actually, here's a good example. This obviously last week ended on a very negative note. Everything was down, 2, 3, 4, 5%. Here, I just have the Deep View Leader screen, another preset that kind of is a great general screen. I review it every single day. And I've simply sorted this screen by percent change today and look for what stocks were up on a day that the market was down 2, 3%. And these are showing relative strength. I've also got the daily closing range here as a column, and I'll sort by that as well to see what stocks had 100% closing range, 75% closing ranges. I'll also, sort by percent change from the open, what stocks showed strength off the open if there was a gap down. That's a way that I like to look for relative strength. Also, one last column here, I've got price percent change for the 50-day. We're below the 50-day right now, clearly on the indexes. What stocks are holding above their 50 days. So depending on where we are in this particular situation, like if there's a gap down, I'll look more at percent change from the open. I'll use these different data points that we have in Deep View to look for relative strength and build that relative strength list. And I've also got the industry column here, so I can see not only what stocks are performing well, but what are the commonalities among the stocks showing relative strength. And this is how you identify leading themes. And what showed up on Friday? Metals and mining, biotechnology, utilities, oil and gas, metals and mining, biotech, capital markets, biotech. This is how you spot the leading themes before everybody else, is you're looking to see what stocks are outperforming and what themes are they a part of. And this is a really clear way to do it in Deep View. So definitely recommend kind of adding this to your toolkit. And it's super easy to add these data points. You can just click this gear icon and search for whatever data point you'd like. Right, anything that you want to add with using columns or how you look for relative strength on a day-to-day basis?
Yeah, there's a great question. There's two forms of relative strength. One is when you weight the calculation for recent performance, right? And one is when you just look at pure performance on a time frame. So we have both capabilities in Deep View, which we call the absolute strength rating and the relative strength rating. So absolute strength is just purely looking at, from January 1 to today, what are some of the best stocks in the market, rank them versus themselves, and then give me a rating of 1 to 99. So that's a pure performance and momentum based rating, whereas relative strength does the weighting of 1 month and the 3 month span, merges them together, etc. So I like to look at the absolute strength a little bit more, especially on a 1 month horizon and the 3 month, because I don't want those numbers to be blended. I just want to know what's outperforming the markets in those two time frames. Um, Another thing is, in the first webinar we covered that, when Nvidia was pulling back, its closing ranges were really nice
On a
as
weekly
it pulled
basis.
back during a
Yeah.
correction. So adding the WCR column during corrections is a powerful way for you to compare, hey, the market closed at the lows of the week. What didn't close at the lows of the week, right? That's a form of relative strength and how bases build up potential demand and how bases form out into a cup or a flat base, etc., is that those weekly closing ranges are always, better than the market closing ranges. And that potential builds out over a span of weeks. And what we call a setup is forming. A setup, a base is forming for you to then eventually find an entry tactic for. So I think in corrections, using the weekly closing range column is important. Another one that I use is the number of relative strength days as a percentage. So I want to know how often the stock is outperforming the markets during a correction, right? So if it's outperforming the markets 60% of the time, I'm very interested. So there's a particular scan we have in DeepView just for that. If you search our presets for 62.5%. I think that is an important metric. It gives me a lot of conviction that I'm looking at the right names with the highest potential when we're coming out of a correction, as well. So those are some of the ones. A very subtle one in deep view in formal relative strength when you're running your screens while the market's pulling back, the industry group that's highlighted, be it biotech or whatever it is on the day. Let's say you're running the deep view leader screen or the up on volume, that is giving you signs that this is the most popular industry group that is consistently outperforming the markets. So in the back of your head, those blue highlights kind of build up and give you, hey, I should be looking at biotechs, or I should be looking at oil and gas. I should be looking at oil and gas, right? So if you did that over the past 2 weeks, you would see oil and gas a lot more. You'll see gold miners a lot more. You'll see China names a lot more, and those will highlight blue in the industry column. So that's how I use deep view to kind of look for relative strength. There are many different ways. Again, what Richard said is right on, right on. Define a way. It could be as simple as looking at 52-week highs in a correction, right? Every stock that is going to go up is going to make a 52-week high at some point. So that's a very generalized screen that you could look at. You don't need to highly specialize or look at some of these stats we're speaking about, but at the very minimum, have a way for you to spot relative strength.
Yeah, and the last thing I want to say here is just because the stock is up on a day where the market is down, you also want to consider the overall context of the chart. If it's an absolute destroyed stock that's just a mean reversion bounce off lows, that's not necessarily relative strength. But, if that shows up again and again and starts forming a trend, then it's more of a stock to take note of. And also, I just want to highlight here, you might see for daily closing range, we actually have a nice visual here, which is awesome, that actually allows you to see the closing range without even bringing up the chart. So here's PGR. It had about an 83% closing range. You can see it's almost a full candle here, and it was up 5% on the day. So even without looking at the chart, I can tell it was showing relative strength on that day. What theme is it in? Insurance. Just like Bryce said, keep track of what groups are highlighted in blue or just showing up again and again here. This one, ONC, it was up 10.5%, but look at its closing range, 22%. So it may or may not be showing relative strength of the day. So I like to combine the price percent change with the closing range, especially using these visuals, which are also for weekly closing range. And that helps you identify a closing relative strength that much easier. All right, so let's get into the examples here. So you made it to the examples. This is the relative strength line here. When it's highlighted with an area in blue, it means it's above the signal line, the 21 EMA. This is the chart of the SPY, a line chart during the same period. And then this is the stock chart with price and volume action. And what we want to point out here is what we call an RS phase, or when the stock is outperforming the markets, and we want to watch it for that next setup, that next opportunity. This is Reddit. It IPO'd back here, formed a consolidation, moved higher, broke below the moving averages. And then this period, this range is super important here and is really critical. And the reason being is during this period, the market was pulling back hard. The relative strength line was increasing because Reddit wasn't pulling back as much as the market. And what happened after the market pressure lessened and we bottomed here? This went on a monster move. And I got involved early in this area because of this relative strength here. And it's really easy. You can just plot a RS line here, SPY up here, and then look for divergences where the RS line is increasing as the market is pulling back. And that is what an RS phase is. And Ryan, jump in if you have any thing to add here. But here's Root recently. This was another correction. The choppiness that we saw, Root was rising in terms of relative strength. You can see during the actual price action, really tight at the bottom of this base. What happens when the market pressure lessens a little bit? This went from 85 to basically 120. It doesn't look like much of a big move here because there's a high ADR stock, but a really strong trend in here. What happened as the market pulled in again? I actually don't have this marked, but it's another good example. The relative strength line was increasing as the market was pulling back, and this is gained about 40% in the past month or so as insurance and this name in particular has done really well. Another example that I also didn't have marked here is here the market's pulling back during this 3-day period. The market really pulled in hard. Root actually increased with a gap up and held firm. And this let you know, this got it on your radar. Again, edges get stocks on your radar that then you could swing trade from this tight area and profit from this trade. But this relative strength edge right here shows up clearly just during this 2-day period. So it can happen really fast. And one thing I want to point out here is, this is a little bit complicated watching for divergences and all this, and it might be a little bit difficult for newer traders. We made a RS phases indicator, which highlights in blue when this characteristic is happening, when the market is pulling in and the relative strength line is increasing. So this is when we're in RS phase. This is when we're in RS phase. During the short 2-day period, this is when we're in RS phase. So this indicator can be a nice way to visually indicate when we're seeing this divergence, especially if you're a newer. Another example, BABA. We've all heard about BABA recently, but it was showing relative strength way back in here, way back in this area. As the market was pulling in, the relative strength was in a clear uptrend, and this is when it really started its really strong phase. And this is getting involved a little bit later. It actually did show relative strength during this area as the RS line continued higher as the market pulled in, but we'll see how this base develops. And just to show this isn't hindsight, this is what I was watching when I put it on the TradeLab report right in this area. So this is back in this flag. This is what I saw and what I was looking for, and why I considered adding this to my focus list is because it's showing relative strength when the overall market is pulling in, and it had just started a nice uptrend and was forming a really nice tight area, tight area on low volume. That's kind of my bread and butter, and we gap up and have a nice strong trend before this base. So this isn't something we're talking about in hindsight. This is something we actively look for every single day in the market, especially when the market is choppy and corrective. This is a great edge to use to try to identify swing trades and position trades when the market pressure lessens. Rye, anything you want to add on relative strength? This is another example of AEM recently. Obviously, miners have been strong. The market was choppy, pulling back. Relative strength line increasing. We pop above the moving averages, start this trend. Then back in the space, look at this. This is so clear. Market pulling in, relative strength line increasing, and then after the market lessens a little bit, this breaks out and begins a nice trend from the low 90s all the way to over 110. So this is a really powerful edge that is definitely worth considering. Right, anything to add on how you look for this on charts and use the relative strength line maybe?
Yeah, I would say, there's no way a stock can hide and outperform the markets without showing relative strength. And that's, you know, that's it. There's nothing technically it could do that is sneaky or delusional or trying to mask itself somehow. It can't. It doesn't happen. This edge has, ever since the beginning of time, especially with charts and everything getting more digital, it's there. You visualize it, you see it, you track it, you look at the setup, and then when the risk is there, you enter that right above the pivot or right, as it goes up the right side. So every correction, there are a list of stocks and a list of themes that come about that have shown relative strength that then trend. Oil and gas just didn't start an uptrend overnight. It was a 3-week process when everything in the markets was pulling back. Oil and gas, miners, China, all of these that are trending this year were showing relative strength, right? So when you were screening, when you're the first acronym of the SNIP framework, when you're doing that and you're looking for relative strength, you'll start to identify it a lot faster. You'll identify to the next one that we'll cover, which is themes, a lot faster. When you see a theme in China, all these China names will go up at once. You want to be in the best one. The best one will have the highest relative strength and maybe the best volume signature as well, right? When you combine those two, that one will outperform every other China name that is in that particular group. And you want to be part of that because then you have two edges at play. You'll have higher conviction, you'll have a higher position size. When you combine that, you will outperform your portfolio, will outperform the markets just naturally. So
Yeah, and I see some questions, why with BABA are we using SPY versus KWEB? It's because we're trying to identify what's stronger than most stocks in the market, and the SPY is a good reference point. We're trying to identify relative strength, and using a relative strength line of BABA versus KWEB can show whether it's outperforming KWEB, but it's not helping us identify where the strength in the market is. We're trying to set a baseline, which is SPY, and then look what's outperforming SPY in that moment. That's why we're using it as kind of the comparison for all these stocks.
Plotting the relative strength line of BABA versus KWEB will tell you that BABA is the top name within KWEB, then nothing else, right? And plotting it versus the market will tell you that when the market pressure was on and the stock was supposed to go down, it didn't go down, right? And when the market pressure suddenly lifts, or we have an oversold rally, or we consolidate sideways for a few days, it will use those opportunities to then rally up the right side, right? So those are two different pieces of information, both key, but the one versus the market tells you that it's about to outperform the markets, right? It's one of the top stocks in the markets for a reason. So.
Yep. All right, let's dive into the N factor edge. This is a really awesome one and fun one. It goes a lot with what Rai was talking about with the HVE, the reasons behind a move. So the N factor is a game-changing catalyst. It's a fundamental development like earnings, revenue surprises, or raised guidance that sparks a significant move in a stock. And basically, institutional accumulation drives a trend, and surprises force large funds to reallocate capital because their spreadsheets are then valuing a stock differently when it earned 100% earnings growth versus what was expected at 25% growth or even 40% growth. It completely changes how these funds have to operate, and they might have to decide, all right, we need to buy 1 million more shares over the next month now because of our mandates based on what we are as a fund. So that's what kind of creates the accumulation and trends after an N factor edge. N factors can emerge at multiple levels, company-specific events, it can be industry-wide regulatory shifts, technological breakthroughs. These can all qualify. Strong growth is key. The most effective N factors are tied to accelerating earnings, sales, typically 25% or more quarterly growth, and ideally triple digits. And this is key because, again, the expectation of future earnings is what stocks are valued on. And strong, catalysts that completely change how a company is valued. Maybe they release a new product that is extremely popular. Maybe a regulatory change allows them to become more efficient as a company. All these changes completely alter how that stock needs to be valued by institutions, which drive, buying and selling pressure in the markets. There's examples that illustrate both sides. Netflix, as we'll show, reinvented itself multiple times with new products, completely changing their business and almost business models, is a positive example. While Tesla's autopilot, hasn't worked out yet, despite it, being a game-changing revolution. Robots, maybe in the future, in 5 years, when you're watching this, robots are everywhere. But right now, they're not a reality yet. So they could be an N factor in the future, but right now, they're not there yet. AI was supposedly an edge, a factor 5 years ago, but it hasn't materialized until 2022, 2023, 2024. So it's when these N factors actually contribute to revenue and earnings growth that they start to matter. And we can see when they start to matter based on price and volume reactions. So here's the example with Netflix. I love this example. This is a monthly chart, and this shows the different phases in the business and the different model book moves that happened in Netflix as a result. This is when they launched streaming and transitioned away from DVDs, and I remember ordering the DVDs, and it was a lot of fun. But once we started streaming, it just opened up the ability to have watch many different shows, watch many different movies, and this contributed to this very strong growth. They also expanded internationally during this period, but then that growth slowed, and we experienced obviously more of a corrective period. It entered stage 4 decline, and then we started a new stage 2 uptrend. And the catalyst behind it was they shifted once more from just streaming to original content. This is the release of House of Cards. Obviously, there were many other shows that came after it, but this is when they doubled down on original content, and this drove this tremendous market move that really lasted until 2022, when again they entered a stage 4 decline. and didn't really come out of it until they changed their business model and launched an ad-supported tier. So this is kind of a great example of, on a high level, how changes to a business and changes to business models can lead to new invigorated trends that then we can profit from as investors, as position traders, as swing traders during this move that this catalyst creates. So I hope this is a good example for you. And yeah, hopefully you guys like this. I really like this Netflix example. Next up, we've got ASTS. We've already talked about this, so I won't spend too long here. But this is kind of labeled the catalyst that we talked about. Breakout on earnings, as well as an AT&T partnership here. They also announced an additional partnership with Verizon here. So again, they're expanding their business by partnering with these major players already in the cell phone space. They launched their first 5 satellites that led to this breakout here. During this earnings report here, which had a really nice, tremendous move. They mentioned advancement in tech and larger satellites. Their next generation is ready for production. So all these catalysts help drive the growth of the business. And we're just watching for price and volume action in response to those different catalysts. Here we've got NVIDIA, another great example here. Obviously, AI is what really drove the tremendous growth that we saw here in its move. Again, about 1,000% move. And these are the catalysts that happened right near the bottom before and during the development from a stage 1 to stage 2. Here's when their next generation H100s entered full production down here. Then the first H100 ship right at the bottom here during this period. Then we've got ChatGPT, where AI started really becoming apparent to everybody during this period. Then it transitioned to stage 2. They announced their generation after the H100s, Blackwell. GPT-4 was released right in this area. And then look at the trend that has led to this, with AI and NVIDIA driving everything, because they are the supplier of the best chips. And so they're going to profit from this theme that was the end factor back in this area. So I think this is another really good example to show how timing of catalysts drive the moves and the longer term trends that we see, because every growth fund has to completely reevaluate what they're seeing with all these new catalysts, all these different factors that are increasing NVIDIA's business triple digits quarter after quarter. They have to revalue it completely, accumulate more shares, and that's what creates the demand that drives this overall move. All right. So here we've got a bonus theme. We've talked about this a little bit. We just wanted to really highlight how important the group theme and also the market are on the trend of a stock. It's going to be really hard for a stock to make a model book move when the market is in a correction and bear market. So here's what's really important. Stocks move in groups. Market cycles are often led by a few strong industry groups, and we call them potential leadership groups, PLGs. Group strength boosts individual stocks. It's an amplifying factor. Even average stocks and strong groups can outperform top stocks in weak groups. External catalysts drive PLGs. Remember, this is NVIDIA, but there were so many other AI-related names that made model book moves. We had other manufacturers, AVGO, all the chip manufacturers. We also had related stocks, the energy names. All this was driven by that same AI theme. A-Lab with the data centers. So all of this is kind of related and part of the same kind of theme. So again, external catalysts drive PLGs, regulatory changes, technological breakthroughs like AI, or economic shifts can strengthen entire sectors. Market trend alignment matters. Even strong stocks and strong groups can underperform in a weak overall market. And what's really important is to trade with all 3 trends. Maximize success and probabilities by aligning with the trends of the market, the group, and the individual stock. That's really, really important. And just to show that, again, we're talking current markets right now as an example, but just think back in history in terms of what were the strongest stocks that went on 1,000% moves, 3,000% moves, 10,000% moves. They were the companies that were growing the fastest based on shifting dynamics in society and the market. Going back way in history, it was the steel stocks as we were, developing the country and building railroads. Then it became rocket ship stocks, and it became internet stocks. Whatever is the shift that's taking place, that's driving tremendous growth, is going to be the leading theme that you should be focused on as traders. And if you identify it early and also notice price action, because price action can lead you to the theme, that's going to completely change your perspective on things and can really improve your performance by finding these trends and leading themes earlier in their moves, so you can then find the setup, find the entry tactic, and profit from these super strong trends. So Ryan, anything you want to add on either the end factor edge or the group theme market edge PLGs?
The group theme market edge is one it's another important thing to track during corrections. When a group of stocks, for example, semis, AI, miners, oil and gas, anything as a whole are all acting really, really well or not going down as much as the market is going down. Um, that leadership group, knowing those leadership groups will allow you to position size in those groups a lot better, and give you more conviction to, double down on an NVIDIA because you see it as one, the clear leader, second, the whole group, which is the semi group, is all behind that particular move, right? And there's nothing better than that. Combine that with, when a group is holding up, it's like, again, it's relative strength at the end of the day, which is one of the edges that we spoke about. So you have to combine some of what we are speaking about in segments uh, at the moment as kind of one analysis that you're doing of the situation, right? If a group theme is acting really well, it qualifies as a potential leadership group. What's the top stock in that that leadership group, especially when the market's correcting? You identify that stock, right? Is that stock is likely showing relative strength and some of these other factors. Then you really focus in on, hey, this is, the one or three stocks within this group that I really want to focus on to make sure I catch the move when the market pressure lifts or we go into an uptrend if and when we do for the markets. So combining, group, theme, and market edge with relative strength, and then identifying the top potential stocks will essentially get you there with the highest position size for your system.
Yeah, perfect. So a little exercise for you guys here live and then also on YouTube. I want you to list in the comments what are the top three edges you use to identify slash judge is a stock worth considering. And if it's one that we've talked about, definitely list it as well. I think relative strength will be pretty common, but let's see what people say. So what are the top three edges you use to identify slash judge if a stock is worth considering, has high potential? Let's see what you guys say. RS, HV, and stages, nice. Relative strength, a lot of relative strength, volume, theme, change, relative strength. Yeah, so a lot of relative strength. Big volume with strong PA, breaking out of base, high quality VCP. That's more of a setup versus an edge. Respect for EMAs, nice. Launchpads, technical, RS volume. Okay, so it looks like you guys are on the right track here. We're going to take just a brief pause here to make sure we've got some questions answered. We're not done. We've got all the setups to cover as well, so definitely stick around. But let's see if we've got some key questions. And also, if you haven't, bought or ordered the Trader's Handbook just yet, if you're finding this helpful, you're going to find the book immensely helpful. If you like this, you're going to love the book, and we dive even deeper into the book and have all the different chapters that we're talking about covering different aspects of building a trading system. And you can scan right here to pre-order yours. Again, we've already got hundreds of people who have pre-ordered, so definitely pick up your copy right here. Let's see. Preston asks, what's an effective method to find the end factor stocks? I think just stay aware about what the shifts are going on around you. AI has been everywhere since ChatGPT came out. So stay on the cutting edge of new technology. See if it actually helps you. That's a great way, is to actually try out the new technology. I know people were actually trying out Teslas and self-driving, way back in 2020 to see how it was a game changer. And so experiencing a product can be a great way to see, is this valuable? Is this going to be growing tremendously fast over the next few years? And then also, again, the technicals can lead you to the theme, as we showed with sorting by looking for relative strength. Right now, the leading groups are miners, biotech, insurance, names that aren't traditionally growth minded, but that's what's showing relative strength. So the technicals and what's showing relative strength as a whole can point you towards the leading groups as well. All right, and I see a question. I missed the first two classes. Where can I get those classes? They're on YouTube, so we'll be creating a playlist for this. But just go to TraderLion, YouTube.com/TraderLion, and you'll be able to find the first two webinars, and as well as all the webinars going forward. All right. So let's dive into the main setups we're going to cover today. We've got a bonus one at the end, so stick around until that. But these are the main kind of segments that that we want to talk about. First, we've got the gapper setup, which really goes hand in hand with the HV edges, very similar. And that's kind of the main setup that we use with the HV edges. Then we've got the traditional base breakout, and this could be an entry up the right-hand side of the base or actually at the traditional pivot, like with this example. And then we've got the Launchpad, which is more of an early entry as the theme is developing and getting underway. This might be the start of the strong move, and then a continuation might be a base breakout or a gapper. So these kind of go hand in hand. They happen at different times during a stage 2 uptrend. And these are great ones and great frameworks to learn. And again, to be a successful trader, you might only need to master one of these or two of these. You don't have to go out there and memorize every setup. You want to specialize and focus and become an expert at just a handful, one or two setups. And that's kind of our recommendation for you guys here today. So first things first, the Launchpad setup. This is one of the core setups of TraderLion. It signals the start of a potential major trend. It also helps identify leading groups because as groups are setting up together, Ross says this so much, you'll see the groups start to curl up, the moving averages start to curl up under all the stocks in the same group. And it's formed by moving average convergence. The setup appears when multiple key moving averages, and these are the ones that we like to use, the 10 SMA, 21 EMA, 50 SMA, 65 EMA, and 200 SMA, converge beneath the stock price during a consolidation. So the stock's been consolidating quite a bit. It then starts to move up the right-hand side. All the moving averages have converged together and then expand upward as the stock breaks higher and begins that strong trend. Group confirmation adds strength. The setup is most powerful when several stocks within the same group form launchpads at the same time, suggesting a sector-wide, group-wide move. This is what I was just talking about here. This typically emerges after corrective bear markets. This pattern often forms as stocks bottom out following major corrections or downturns. And a good example is NVIDIA in 2023. NVIDIA formed a launchpad in January and rallied 400%, demonstrating the explosive potential of this setup. So we've got a lot of examples here. This is how you can scan for it. We've got a data point launchpad in Deep View. This is an example screen that I created. Launchpad data point, yes. Dollar volume over a base amount, over the 200 SMA, percent off 52-week low, 2-week lows. We've got a criteria there. So this is kind of how you can scan for it. Or you can just kind of go through a major screen, a general screen manually and see and look at the moving averages and see how they're converging under price and look for it manually as well. So here is the NVIDIA example. We've been in a long-term corrective phase. Then you can see how all the moving averages get bunched up here. This is what Ross Haber likes to circle here. This is the launchpad. This is the supporting mechanism that will bounce the stock and create that strong stage 2 uptrend. And you can see we break higher. And obviously we all know what happens next. We go on this tremendous move with NVIDIA. And you can see tightness below during the base below this. It respected all the moving averages. This is why it's a great place to get involved, because this will be, all these moving averages will be supportive of the price action. You can manage risk against them and use entry tactics during this, using this setup to then profit from the strong trend. Here's another example recently of AEM. Obviously the miners all kind of show them. You can see all the moving averages bunch up and then we expand higher as miners break higher. Then you could trade the first pullback, range breakout here, the base after this. But after the launch pad, that's the overall setup that can kind of set this in motion. We've got another launch pad here that leads to a trend, but not nearly as strong. You can see we fall back into the consolidation. But this is another really good example of all the moving averages just bunched up. This is what we're looking for in terms of the launch pad. Then here is IBIT back in October of 2024. Look at how all the moving averages got really tight here, compressed, and then what happens? We expand higher, and there are many different entry tactics that you could have used to enter during this time and profit from, I think, this 70-80% move in IBIT after the launch pad. Another example, we've got BABA. This has been, of course, an emerging theme. Launch pad right here against the 200-day moving average, expansion up, and then you could have traded this next tight area and profited from this move as well. So again, you're looking for all the moving averages to converge under price, and that's what we're looking for here. All right, the gapper setup. Ryan, I'll hand this over to you because it really ties into the HV edges.
Yes. So the gapper setup. So first is we identified, a visual characteristic. Now, how do we form, how does it form a particular setup on the charts, right? What you want with the gap ups that you see, especially the high volume ones, is they have to be really early in the stock's uptrend. Those ones have the most potential And the second thing that you're looking for is that the closing range on that particular day, again, this edge is on the daily time frame. There's a lot of questions on which time frame. It's the daily time frame that we're looking at. The stock has to close, if you take one that closes with 0% closing range and on that particular HV day, and you take one that has more than 50% on that particular HV day, the one with 50% or more will have higher success and higher probabilities, right? There are many, many examples of the gapper setup, which is essentially, the high volume edge showing on the charts and then forming, a consolidation coming into volume support, a pivot of sort. But the most important thing is the closing range on that day has to be really good. And the earlier it is in that particular uptrend, the higher the potential that the stock continues to have become a serial gapper over the next couple of quarters here. A good example of this is ELF. If you pull up the charts for 2022 and 23, you'll see that the whole run started from the HV1, and then we got every earnings cycle. This thing gapped up and up and up and up. And the way to identify these particular stocks really early in their trend is to look for the HV edge and the setup to form so that you can continue, you can catch one of these serial gappers where it moved from about the 20s to the 120s in a span of 8 to 11, 8 to 12 months. So that's the gapper setup. There are many examples. We could likely create a whole model book. I think in the book we have hundreds, tens, I would say, of examples at the end of the book that we've included of this. And it all starts from actually, looking at it on the charts, making sure that the daily closing range is as high as possible on that particular day. And we're early in the trend. The Arlo example, the Uber example, the WGS, if you guys pull up that chart and scroll to the left, that example, that stock moved 280% last year. Any of these, the earlier in the trend they are, the more potential that they have to increase and then some.
Yeah, I think ELF was kind of an outlier with the number of gaps it had that kept going, right? We like to focus on the first one or two or maybe three in specific cases to then look for an entry tactic after it. In DeepView, there's some really easy ways to scan this. Again, today we want to give practical systems to find these setups. We're not just talking about these setups theoretically. This is how you can screen for them pre-market. This was a screenshot before the quantum stocks recently had a really nice one and a few day momentum move. And in pre-market, there were so many quantum names gapping up on over 10% of their average daily volume. That's the kind of metric I look for. So we can measure basically the pre-market volume versus the average volume for a particular day. And when that's over 10%, that to me is significant and suggests that it may have the potential for a nice one-day gapper setup opportunity. And then on post-market, so you can look at the day before as well, I like to see a stock have, over 30% of post-market volume versus the average, or, even better, 50%. Or here with Okta, which led to a nice, I think, 20% move very shortly. This is a screenshot from the Trade Lab. Again, we're talking about real time here. We're not talking theoretical here. Okta, the day before it started its nice 20% move, it had over 100% post-market volume compared to normal. These are the type of numbers we're looking for to identify the outliers which lead to strong gapper setups and strong opportunities going forward. So that's kind of how I like to look for these gapper setups, as well as HV edges, is pre-market looking for over 10% average volume with a gap, and then post-market the day before looking for over 30%, but ideally 50% or even higher in terms of volume post-market compared to the average on a daily basis. So here is that ELF example. This is highlighting in DeepView. You can hover over any of the earnings reports and see the surprise. This is what led to these gaps. Is again, institutions have to completely reevaluate ELF because it's beating earnings expectations every single quarter, and revenue guides are higher. So it has to completely reevaluate, and then they have to allocate more size, and that leads to the trend that we see here in ELF. And this last gap here, you can see this was sold into. So this is what can happen to gaps later on in a trend is they get sold into. This led to a correction and eventually recovered. But we like to focus on earlier gaps, which present just higher reward to risk opportunities. Here's a good example, and this is actually a sneak preview of the model book chapter of the Trader's Handbook, where I mentioned we include examples of these moves. This is Tesla back in 2019 before its climax run, and this is the catalyst down here that I talk about. This Tesla gap started its model book move from 2019 through 2021. The gap was on the highest volume in over a year, so it's showing that edge. And then the next day surpassed that once again. So highest volume in over a year, HV1. The next day, another HV1. Tesla had reported a surprise profit, and they had announced that execution of its expansion of new factories and new vehicle models was ahead of schedule. Again, we're looking for growth in future earnings, and that fits that bill exactly. The key question with Tesla up to this point was whether it could become consistently profitable. And this earnings report was the turning point to answer this question. That's what led to this big move. And that's the edge that we're looking for. And here's kind of a quick blurb about it. Early in a stock's uptrend, or even just to start it, gap ups can be an excellent opportunity to build a position with strong momentum and accumulation behind you. The catalyst behind the gap is also very important. The best news catalysts are complete game changing for the company, a huge partnership announcement, a breakthrough in technology that will lead to big EPS and sales growth, an incoming new stellar CEO. AMD is a great example of a CEO completely turning around a company, surprise profitability, regulatory changes. All of these can lead to strong gaps that lead to strong trends. We want the catalyst to completely change how institutions value the stock, leading them to have to add to start positions, creating the trends that we can ride. And I label a few of the different entry tactics that we can use. Again, we're just talking about the setup and edge here, and that's just identifying this part here. The second part of the equation is how we actually enter and execute, and that's the focus of the next webinar. I see people asking about stops and stuff. We talk about all that stuff in the next webinar, where we specifically set our stop losses, how we manage risk, all of that, and how we enter after identifying these edges and setups. Tesla, set up a lot of good ranges, which would be kind of how I would enter, and respect for HVC through right here. Those are just some examples of entry tactics you could use for this example. Here's Reddit again. This is kind of a quick note about this gap here. Again, it had a huge surprise profit. It was profitable for the first time. EPS surprise 322%. These are the type of numbers we're looking for. And they also indicated more daily active users than was expected. So again, these are changing how institutions are valuing the company. And that's what leads to strong price changes and trends that we can profit from as traders. Here's another example. A-Lab, they announced new technology here that led to this gap along with a profit target raise. I usually don't like profit target raises induce gaps, but this one also had a new technology involved with it, and it ended up working well. And then this earnings gap again was led to a 31% surprise in terms of EPS, indicating a lot of future growth expectations and leading institutions to have to reevaluate how they're analyzing the company. So this is some good gapper setups. I trade this one, bought day one, added here as a reconfirmed higher, trade this from this tight area. So all these entry tactics that we'll talk about in the next webinar, those are the things we apply after identifying the edges and setups that we're talking about here in this webinar. Next up, we've got, this is PLTR, the same earnings gap up we talked about previously. Palantir on this earnings report achieved its second consecutive quarter of gap profitability. Again, that was the key question, and often with recent IPOs that are just focused on growth, that's the key turning point. That profitability is the turning point that leads to their second major move in the markets, is when they prove to institutions that they can be profitable and their business model works. They also announced here an AI platform introduction that helps companies integrate large language models. This was very early on in the AI boom. And again, this was the catalyst, this earnings report, that led to the 1,000% move over the next two and a half years. So this type of news around an earnings report or just around a gap is what you want to pay attention to. And PLTR is an excellent example. All right, then we've got Tesla. Again, we've got an earnings gap starting this recent trend, but then we also had the election as a catalyst for this move. So again, catalysts can come in different shapes and forms, and this led to a nice 70% move before it obviously has started correcting since, but this led to a lot of tradable opportunities during this area. So that's all I want to kind of say on the gapper setup. Right, anything you want to add to kind of close things out with
I
the
would
setup.
say the more you look at these, the more that you will identify and different entry areas, or if it's already part of a theme, right? Or a PLG in the market, especially with the ALAB gap that we saw, right? It was a newer name in the markets related to the semis, but the semis were actually doing really, really well at that point, right? With things just were using AI as an excuse, or the semi space was using AI as an excuse for, there's a lot of demand, there's things of that nature. A lot of stocks piggyback that run and doubled in
Yep.
that point in time. So you combine the gap up with the relative strength. Obviously, each of these showed relative strength, but then you had a leadership group in the markets to back all of that momentum, combined with the market itself was in a strong uptrend, right?
Yep.
When you those three or four factors all align, these stocks moved up. The A Labs, the Nvidias moved up, 80 to 100% in a matter of 6 to 8 weeks. Um, so yeah, that's all.
Yep. And then we've got a surprise giveaway for everybody who's stuck with us so far. For a chance to win a TraderLion Masterclass, scan this and share that you're enjoying this series on Twitter. We definitely appreciate the support as well. And you basically are entering to win a TraderLion Masterclass. I'll announce the winner tomorrow. And then everybody who does tweet this out, I'll DM them a $50 gift card. So even if you don't win the Masterclass, you'll get a $50 TraderLion gift card for participating. So I'll pause here for a moment to see if there's any questions, and definitely take advantage of this. And we've got great master classes at TraderLion, of course, that can help expand the edges and setups that you're using in the market. Let's see here. In your regular market updates, you use two different post-market screens. What's the difference between them? I don't use two different post-market screens, Shane. So maybe shoot me a DM and see what exactly you're looking at there. All right, let's keep on moving because I know we're getting close to 2 hours here. All right, the base breakout setup. So this is kind of my bread and butter. This is probably the one I trade the most. And it is basically a continuation setup. The base breakout is a continuation setup that follows a prior uptrend and forms after a multi-week consolidation, typically at least 5 weeks, distinguishing it from a trend starting setup like the Launchpad or new stage 2 uptrend. We're looking for tight price and volume action within the base. It can often happen near the lows, suggesting accumulation, but also as the stock progresses up the right-hand side, that's when we want to see it because it's really indicative of institutional accumulation. We're looking for early entries up the right-hand side. We've got many entry tactics we'll talk about next week, oops reversals, as well as consolidation pivots that allow us to enter up the right-hand side of the base, manage risk, very tightly and logically, and get us in before the true breakout. Because the true breakout of a base is often, as the stock is it appears extended, and there's often a pullback after the breakout that will shake you out if you just buy at the pivot. So you want to buy tightly and logically early up the right-hand side. After a strong breakout, we're looking for a clean move up on increasing volume, suggesting institutional involvement. And there's often, and this is something that Ross has noticed more and more in these markets, there's often, after the breakout, a pullback to the pivot or a pullback to the 21 EMA that's actually an additional actionable setup where you can buy as it reconfirms higher after that pullback. So if you miss the breakout, don't be too worried because there's often a pullback opportunity shortly thereafter where the stock will tighten again and then reconfirm higher. So that's a little bit about the base breakout setup. Here's an example about finding base breakouts. Right now, there's not much to talk about in terms of base breakouts, and just in general, during a corrective period in the markets, base breakouts are almost to be avoided, especially standard base breakouts, because institutions will use that liquidity to sell into. But during a strong uptrend, what we're looking for and what I do is I look at the day view leader screen, sorted by relative measured volatility from high to low. So 0 is the low volatility, very tight action, and then 100 would be expansion. And I look through the tight stocks first and look to see how they're setting up within bases. And if there's a stock forming a clear consolidation pivot, clear range with tight RMV, maybe it had inside day the day before, that's how I look to find and enter base breakouts before the true base pivot, which would be up here. So this is just kind of a way to look for it using RMV, which is a real time saver to find actionable base breakout setups. Here's some examples. This is a classic one app. Again, this isn't hindsight. I mentioned this in the trade lab the day before, looking at these two tight days. Nice breakout, textbook volume action after this. This is a beautiful base to study and a nice reversal extension at the bottom off the moving average. Reclaim the moving averages, try to break out, and then this is a good example of the pullback to the 21 EMA, and then that is really what takes app to the moon and led to a really nice trend. I think it doubled shortly after this move. Here's another example, QFIN in the China space. Different type of base here, a nice tight action, then undercut of all these lows and then rally. Then it actually broke out with a gapper. So you can kind of combine this with a gapper setup. And this led to a really nice trend. Then you have an additional opportunity against the 21 EMA here as it formed a tight range. And then it was off to the races. And of course, the China stocks have trended really, really nicely. I love how on this pullback and tight range here, look at the volume here. This is what we talked about in the previous webinar. Constructive price and volume action, breakout on high volume, pullback on lower volume, expansion up again on higher volume. So that's really textbook. Then we've got NVIDIA. This is a great textbook base to study, contracting from left to right, getting tighter and tighter, respecting the moving average the day before the actual true breakout. That's a golden nugget that you want to look out for. In these bigger bases, if a stock which previously didn't respect the moving averages begins to respect them, like here it's supported at the 50 SMA, here it tries to pull back again, supported at the 50 SMA, that is often an indication that it's getting closer and closer to being ready to have a breakout just like this. So look for respect for the moving averages within a base after it previously undercut and rallied and didn't really care for them. This is a sign that institutions are really accumulating the stock on any pullback within the base. And this led to a really nice breakout on an increase in volume. Here's another sneak preview of one of the model book chapter stocks from the Trader's Handbook. This is GEV, a really nice base setup here. Again, in a leading theme at this time, we had the extension down, strong close. At that point, we're watching for the 21 EMA reclaim and then tight ranges really near the pivot. And we point out a bunch of inside days and entry tactics here, oops reversals. But here's the breakout here. And then you've got a follow-on breakout right here that leads to a really nice trend in a matter of days and weeks. And then I point out here the low volume during these tight areas, constructive price and volume action. So definitely study this chart and you'll be able to study it in the Trader's Handbook once that's released. So one more here, we've got another example from the Trader's Handbook model book chapter. AMD, there's a different looking base than GEV. We have a more gradual pullback, breaks below the moving averages, pops above it, pops above this downward trend line as well, but then sets up a nice tight range, higher low here. And then this is the early entry point here. You can add more through this short-term range, add more on the oops reversal, and profit from this really nice trend before it broke below the 21 EMA. So on a longer base, this is a key thing I want to say here. You can use a downward trend line to judge when the stock is ready to move up the right-hand side like we saw here with AMD. And I love this tight range on low volume. That's exactly what we talked about in terms of winning characteristics last webinar. So that is the base breakout setup. Ryan, anything you want to add on base breakouts?
In current markets and how things have changed, base breakouts act as continuation entry points, not initial entry points. And Ross, who made a model book at William O'Neill, was a portfolio manager at William O'Neill, etc., developed what he calls consolidation pivots instead of base breakout pivots, right? Consolidation pivots are earlier up in the right side of a base. Whereas base pivot entries that used to work 10, 15, 20 years ago, where you simply wait for the base to finish and you buy that day, are less likely to succeed, in current markets. So that's how traders, come up with new entry areas, new methods as we go up the right side. It's important to see base breakouts today in today's market at the pace of play, having completely changed as it wasn't like this 20 years ago, but it is like this now. So we have to adapt to it, right? So base breakouts, do they work? Yes, but they should always be treated as secondary or continuation type of entry areas where you're adding to an existing position. Can you start a brand new position at a base pivot? Yes, you can. In certain markets, it is forgiving, especially if it's the top leader in the markets and it's completing out, a multi-year base. it can be forgiving in those, but in recent times it hasn't been. So always, adapt. Like we said, your edges can fade with time, they can become obsolete, but then you have to adapt and be fluid to the situation and how the market's trading today, as well. So just my 2 cents is treat them as continuation setups, add to your existing positions.
Yeah, that's exactly why we point out the main entry area here is this early consolidation pivot tight range here. And then it's not a surprise that look at these two bars right near the base pivot. It's not a surprise that they fade and lead to a pullback. It's because traders who purchased right here or institutions who purchased back in here are using that liquidity to exit at this base pivot. And then the next really good entry is actually after that shakeout finishes and we get a strong oops reversal. So we don't want to really trade near the base pivot. We want to trade up the right-hand side before it happens, and then shortly thereafter, after the pullback, and it reconfirms that strength. So Rye, I think that's well said. All right, so we've got a bonus setup, pullback to support. Support levels can be, key levels. It could be a base pivot after a breakout, slightly before. It could be a moving average, such as the 21 EMA or 50 SMA, or another relevant level. And although we're saying level, what we really mean is an area, because stocks aren't going to respect a level to the cent all the time. It's really as it approaches, plus minus 1% is what we're looking for in terms of looking for respect. Again, this is more of a continuation setup after you've kind of built up an initial position. The pullback setup to support is a great way to add. And, if you establish your core position at 15%, you could add 5% when it next pulls back to 21 EMA. And what we're looking for is a constructive pullback, not a sharp break lower in 1 or 2 days, going from all-time highs down to the 50 SMA. We're looking for a drift down on lower volume because the healthiest pullbacks occur gradually with little signs of intense selling. And what we're looking for is a risk reward entry advantage here, because what's great about pullbacks to support is it's really clear where the line in the sand is to trade against. And you can put your stop loss after it shows support for it and rebounds up right below that key level, allowing you to manage risk tightly and logically, which is what you're looking for in terms of setup and entry tactic. So here's a quick thing on scanning for pullbacks. In Deep View, it might be hard to see, but this is basically a screen that looks for stocks right around their 21 EMA. This example, I ran it this morning, looking for strong stocks pulling back to the 21 EMA. There's a preset called the Power 21, a powerful move higher, and then a pullback to the 21. And then we're watching for respect against that level, maybe a range to form, an oops reversal, some type of entry tactic if you're interested in looking into the stock for other edges and other reasons, regardless of the 21 EMA pullback. Because it's a good example of how to scan for strong stocks pulling back to their 21s. So now we've got another exercise for you guys. List your setups down below in the chat or in the YouTube comments. What are the top 2 setups that are kind of your bread and butter that you use for trading? Definitely be interested in hearing what you guys have to say. All right, so let's see what people have. My probably main ones are base breakouts up the right-hand side and then pullbacks. All right, we got pullback to the 21 EMA, pullback to the 50 SMA, HVC and pullback, nice. VCP, Launchpad, VCP, base breakout, nice. So we're kind of on the same page here. Low cheat, that's the same thing as the up the right-hand side range breakout. That's great. Nice, still figuring it out. That's a good, honest answer, great. EMA crossback, nice. Pullback to 21 EMA, perfect. So you guys, we're on the same page here. That's excellent. All right, Ryan, do you want to take this slide? I think this is something that you get across really well.
Yes. So a lot of what you guys will see or saw today was us discussing multiple edges and multiple ways and multiple setups in the markets, right? So it's very important for you to not try to, get all of this and apply it on Monday morning. All of that will take quite, time, and through repetition and failure and success as well, you will get to learn to see what setup or what edge or how you see the markets and how you see risk, and what appetite you have for yourself at the end of the day, what fits you best out of these, right? If you take anything out of today, is take the framework of what we gave you and apply it to any system that exists out there. That's our biggest focus. What we're trying to do with, showing examples and really particular edges that we do is that we're trying to show that the framework that we put together is, can work. It does work. And it's a really great way of thinking about the markets. But all of that aside, I think traders tend to not focus in on one particular thing and really master that, right? If you don't specialize, you will never be the best at that particular thing. If you're trying to do too much in the markets and you have 10 indicators trying to align at once for you to have an edge, it becomes infinitely harder for you to do what you need to be doing, right? So if I were to pick a particular indicator, it would be the relative strength line that I want to look at. It's the only indicator that I use outside of price and volume at the moment, right? So pick one setup, pick one style, and deeply study that particular style. It will get you to stage 3 and 4 that we spoke about in webinar 1 and 2 a lot faster than you trying to be a fundamentalist, a technical trader, a day trader on some days, and a swing trader on another day. Specialization essentially allows you to build intuition. Intuition is, your second nature kind of kicks in and it helps you, this is a good HV, this is not a good HV. This is a market leader, this is not a market leader. And that comes through specialization, you narrowing down your focus, repeatedly looking at, when I look at a HV gap and I look at, CRNC gapping up to 27 and a half, I knew that thing's going to blow its tires and completely pull back. That's intuition that you develop over a span of time through experience, right? Don't try to master the third point that I have is don't try to master everything at once. Again, that speaks to the same thing. If you try to do one thing well, you will get better at it. And at the end of the day, the market is, if you execute that one setup or that one entry tactic really, really well, you will become a stage 3 trader right away because you're in the consistency phase, right? You're being consistent with that one thing that you know works for you, and you patiently wait for that thing to show up again and again and again, right? So pick that one thing and then you can, expand over a span of time. It takes about 10 to 12 years to have multiple things that you're really good at in the markets. But what traders do in stage 1 and 2 is they try to master all of it while not really being good at any of it, right? And that leads to them being in stage 1, 2, and eventually quitting and not getting to 3 and 4. So become an expert of one blueprint. That could be any system, could be stage analysis only, right? Stage analysis still follows the framework of seeing an edge, seeing a setup form, and then getting an entry tactic perfected, right? You could apply the SNIP framework that Richard discussed at the beginning of today's call to stage analysis, or let's say Mark Minervini's method of SEPA, or Can Slim as well. All of these things all fall under the frameworks that we discussed today. They all have an edge that is visual. They see it on the charts, or it's news-based. They all have setups, which are in William O'Neill's case, bases that are forming. And then he has really specific criteria on when you can enter, right? His criteria was on the day of the breakout, the volume has to be a certain amount. The price has to close above and not pull back more than 7%, right? For me to stay in. So those were his entry tactics that he spoke about. So specialize, because that will lead to mastery. If you try to do too much as a stage 1, 2 trader, you'll leave yourself confused. You're not really good at anything. That means you're not consistent at anything. And if you're not consistent, you'll never reach that stage 3 and 4, the phases that we spoke about. So I think with that, we are done for the day.
Yeah,
I'm
that
done
was
for the
actually.
day, but you have a webinar.
Yeah, I got one more. No, this is great. Hopefully you guys found this really helpful. I saw a question, which setup should you start with? I think up the right-hand side of a base, I think is a great one to study first and foremost. That's kind of my bread and butter. But you could pick a gapper if that appeals to you. Pick that one and just master it. Study model books, study the one that we're going to put out, and just build that intuition, build that second sense, second nature around that setup. Here's what we recommend for DeFi. We showed a lot of applications of DeFi today, how it can help speed up the process, finding relative strength, identifying tight areas, all of this. So definitely check this out. Analyzing earnings and sales growth, sponsorship, all of that. So definitely check this out if you haven't already at DeFi.com. I saw a lot of DeFi members already in here. That's great. Then also, if you haven't yet, go ahead and pre-order the Trader's Handbook. Again, if you found this webinar helpful, you're going to love the Trader's Handbook. It provides a clear framework to build your trading system, and if you've already got one, how to refine it. And there's so much detail in here that we haven't even touched on yet. So definitely check this out if you haven't already. You can scan this QR code. The link will also be in the description of the YouTube video. So you can go ahead and order it that way. We've already had hundreds and hundreds of people who've told us they've pre-ordered. And thank you guys so much for your support. This is a resource that we've worked incredibly hard on over the past year. And we're really excited to share it with you guys. So definitely go ahead and order it if you haven't already. With that, I think we can pretty much close things out. Let's see if there's any last questions here that we should answer. And I see a lot of questions on entry tactics. That will be the subject of the next webinar. So if you haven't registered yet, we'll be sending out the links in an email later on this week to sign up for the next webinar, which will be next weekend. So definitely look forward to seeing you guys there. Thank you guys all for the nice messages. Appreciate it. And really, we want to, from the bottom of our hearts, help you guys build your system. And we really hope that this webinar was helpful towards that goal. So thank you guys all for tuning in, and we'll see you guys at the next one. Cheers.